This is Jay Martin.
Thanks for coming back. I would like to jump right in here. As always, we have 20 minutes and tons that I would like to cover, so we're going to cut right to the chase. Welcome, Danielle. This is our first in-person conversation.
I know, it's pretty. I'm happy that we're not virtual. This is awesome.
Me too.
I like the non-virtual.
So let's start with a quick introduction. I'd love you to let the audience know who they're hearing from if they're not familiar. And so 30 seconds or less, who are you and how do you spend your time?
I started off on Wall Street in the 90s. I kind of discovered the invisible hand of the Fed. I ended up retiring very young, so to speak. Thought I was going to never work again and ended up being a bureaucrat. Worked for Richard Fisher, advising him on every aspect of the economy and the financial markets for the better part of a decade throughout the financial crisis. I've since come out, followed him into retirement, and I have a company called Quill Intelligence. We publish 8 times a week. I hope you're all subscribers. Shameless plug.
I love it. I love it. And Nomi, one more time, please.
I was a former Wall Street insider. Last stop was Goldman Sachs a number of years ago, and now I write books and work with different governments around the world in terms of following the money, following economic developments, and particularly new developments, which is why I'm very excited about being here for natural resource developments, and particularly the field of economics into new energy, which I think is really important to all of us here.
All right, I love it. So to lead into today's discussion, I'd love to start with you, Nomi. I've heard you say the past belonged to Wall Street and the future belongs to central banks. Could you elaborate on this a little bit to start the conversation?
The present and currently, the future does belong to central banks in that they have been able to create or fabricate $41 trillion worth of money globally out of nothing, not out of productive anything, not out of economic development, not out of production, not out of human innovation, but simply by flipping a switch, as colloquially we can say that. The Fed in particular has fabricated $9 trillion since the financial crisis of 2008, with more than half of that coming since the pandemic of 2020. So the immense power and the relationships that Wall Street had with the government in the United States and in general throughout the world, from the financial community to governments around the world, has sort of been superseded in that Wall Street uses this money, leverages this money, diffuses this money, and it's a lot of partnerships with companies and mega asset managers and such around the world, but they can't create the money. And so the power to create the money has been turbo boosted by the central banks this century since 2008, and that's created a very great distortion between the financial markets that inhale that money and the real economy that is left behind by not being able to do that to that same extent.
Now, I'd love to introduce, if we can, the concept of modern monetary theory as best as we understand it. I personally feel like this is a new concept that maybe no one truly understands yet, but we're starting to wrap our minds around. Maybe that's just how I feel. But I'd love to know your thoughts, Danielle. What is modern monetary theory and what will it change?
Well, I think we've seen modern monetary theory. We've seen the whites of the eyes of modern monetary theory. The April 20 CARES Act effectively signed socialism into law in the United States, and that was followed by 2 subsequent stimulus bills, and we have seen what it looks like to pay people to not work. And it accomplishes 2 things. It destroys the work ethic, which tears at people's dignity and long-term financial well-being, and it creates a lot of inflation. You would note that Ben Bernanke imposed a 2% inflation target in January of 2012. Between that time and when the pandemic hit, 11 months. They were only able to hit this 2% target in 11 separate months over the period of effectively a decade. Now, when you monetize fiscal spending that is directly deposited into checking accounts and given to people with the highest propensity to spend, you're going to generate inflation and lots of it. And by the way, to Nomi's point, this has been to completely non-productive means. We've accomplished nothing with this. The actual nominal level of savings is back to where it was in 2013. In other words, all of the money and then some has been spent. So we have taken modern monetary theory on a test drive, and that little dummy crash car into the wall, the airbags didn't deploy. It's been an unmitigated disaster.
So does this does this therefore change? Because my question therefore is like, okay, what happens next then, right? And I'm led to think maybe this forces us to redefine our understanding of what money is. And as I understand the utility of currency in modern monetary theory language, it's no longer, a currency as much as it is a share of the net asset value of the United States of America. And so if that's what it becomes, then is debt still debt? If it's government debt, our debt will always still matter. But are we moving towards, because these numbers are colossal, and it's hard to wrap your mind around what happens next. Like, how do we, this distortion, how do you reverse that? I don't see that ever happening. So what has to happen instead then, right? And does that mean we're moving towards, we can't avoid a scenario where government debt is just something we don't talk about anymore, it doesn't matter anymore?
That's a great question, and it is a permanent distortion, which is why I do call it that in my upcoming book, because that genie, that bottle that crashed into the wall, is a result of this fabrication of money, and the government, and this particularly happened, as Danielle mentioned, in the wake of the CARES Act. What happened was modern monetary theory is not actually modern. It's something that started in the 1970s, and the idea or concept was that if you were able to create money and you had a strong enough currency connected to that money, as of course the United States did and does because of its reserve status for the US dollar and how immense and what an immense head start that had since Bretton Woods, since post-World War II and so forth, you can perpetuate the creation of money to do whatever the government needs to do. The problem with that is we have a central bank that buys that debt, and not just in the United States, but also throughout the world. So what happens is the government creates debt, and that was one of the things that happened with the CARES Act. The CARES Act's value was about $4 trillion less than what the Fed created in the wake of that CARES Act coming out. So the CARES Act was around $2 trillion, and there was about $6.2 trillion when you added in the $4 or so trillion that the Fed basically fabricated as well. What did they do with that money? For the most part, they bought debt. So all that was happening was there was a sort of shell game going on between the government creating debt and the Fed buying debt. And, if you're in a closed shell game, money is not really diffusing into the real economy, which is why we have this this permanent distortion. But there are areas, because the government is focusing on them, because private investment is focusing, because this distortion is pushing money into the edges, looking for new places to go because it's still so cheap and so abundant, that we do look at areas like new energy, like certain infrastructure and other things that will actually suck in some of this money and kind of lead the way from this permanent distortion into just sort of a new economic paradigm.
Anything to add to that, Danielle?
I would add that there's a new sheriff in town, and he's the old sheriff. And you may or may not have noticed that the stock market is not happy with Jay Powell since Thursday afternoon, when he was finally, after being basically held hostage by the U.S. Congress, shamefully held hostage. Now that he's been confirmed, boy, have we seen a change of tone. And he does not like modern monetary theory. He does not like monetizing the debt. That's not what his roots are. He is a Republican. And I think that he is going to try his very best to stand in the way of the Federal Reserve being recruited to simply be a conduit through which to deliver socialism. So we are at a critical juncture. And it doesn't hurt that the midterm elections are upon us as well, because I think that there's going to be such a violent swing away from the progressives and the direction that they wanted to take the United States, that at least we're going to have some grace.
So is the choice he's making right now either to protect the US dollar on a global stage, which is better for the rest of the world, but he's got to sacrifice the US economy to do so?
He absolutely does, and he's saying so. He's saying that not all outcomes are in his control, which is code word for saying we're going into recession and I'm going to let it happen.
So then is that the necessary Band-Aid that has to be ripped off? Because that's what Volcker did, right? He took a bullet, right? Protected the US dollar on the global stage, threw the United States into a recession for the betterment, right, of the United States down the road.
Right.
The
only difference is Volcker was cleaning up somebody else's mess. Powell's cleaning up his own mess.
Right. Okay. Well, when I first met you, you said, back in the day, you were initially a huge fan of Powell.
I
and
was.
he was the hawkish chairman. He wasn't going to do all the stimulus that he ended up doing, and you were shocked at how he pivoted.
I embarrassingly founded the J. Powell Fan Society. I did that. I was the fan club starting member in public, on Twitter. I don't recommend it.
Okay, all right. But anyways, he's pivoted back to the J. Powell that you knew. I mean, that's...
It appears to be. And we're watching things like today's activity in the stock market. We're watching junk bond spreads gap out. We're watching bankruptcies increase. We're watching sales decrease of junk bond issuance is down 75% year over year. Something's going to break. And we're witnessing things breaking, but I would postulate that he's going to keep going until something big breaks. And that is of a systemic nature. So far, it's a contained explosion.
Nomi, do you agree with this, that Powell will continue his hawkish path until, and I'm really curious, what is the something big, but until something big breaks?
Well, I think he's stuck in trying to be that sort of big anti-inflationary, even though he sort of missed the concept of inflation in the real economy, calling it transitory, as we know, for so many months. And there's a political necessity to be there to sort of do something about it. And some of you who were listening to me yesterday perhaps heard me say this, so I'll repeat it. There are two kinds of inflation. There's the monetary inflation. There's creating and dumping money into the markets, and it goes where it goes. And it's kind of like a virus, and it looks to find the place where it can multiply itself the quickest and the easiest and the fastest. And sometimes we have these pullbacks, which we're seeing in the market right now, and we do get into correction territory, and that's what we're seeing, because the markets hate the uncertainty of trying to figure out what the Fed's going to do, and they hate more than that the uncertainty of possibly facing money that isn't as cheap as it's been historically. But at the end of the day, there's the political side of what Powell has to do, and then there's the money side of what Powell has to do. And I think at some point, that point of sort of the recognition that Powell's really upsetting a lot of players in the markets, and the markets are seeing and saying that to all of us with all the sort of red lines down. And at some point, the Fed's going to have to find language, I think, and Powell will have to find language, whatever he thinks in his inside of him, to say, you know what, growth is slowing. The recession could be upon us. Inflation is something the Fed can't control, which is sort of part of the language that he was saying the other day. The Fed cannot create food. The Fed cannot create oil. The Fed cannot create natural resources. The Fed can't find a lithium deposit. The Fed can't do these things. And so as a result, I think there's going to be a stepping back of the language, and the projections of the rate increases will not be the realities of the rate increases. Will we have them the next two meetings? Possibly, but I think we get towards the second half of the year, and the markets have said what they need to say. Wall Street said what it needs to say. The economy will have problems. As Danielle mentioned, we're seeing bankruptcies coming in. We're seeing spreads gap out. We are seeing people start to default on their credit card payments or be late on their credit card payments because rates are so high. So that's all. It's not going to be one moment. It's going to be, oh, wait, how do I get myself out of this sort of role I've just put myself into? And I think that is when we're going to see a dialing back of these rate hikes, and the projections will slow down.
And the major difference between Volcker's era and Powell's era is the debt picture, right? And Volcker has said what he did wouldn't work today, right? So talking about this something big, what is the something big? Or is it, as Danielle said, a sort of waterfall trickle of events, one thing after another, eventually becomes too much?
It is exactly that. It's this confluence of the markets being read for too long, of Wall Street starting to see its own credit problems with its own corporate clients. Countries around the world are facing more massive inflation in sort of the third world and more the developing countries than they are in the developed world, and that's taking a major toll on everything from creating more civil unrest to economic disparity to inequality to just difficulty in day-to-day world. The dollar has been strong basically since 2008. It's just gapped up since the pandemic. The dollar relative to the euro is, close to super highs. It's making it very difficult for the world to pay its debt. So again, all of these come into play, and we're moving in that direction where the Fed's going to have to say, look, there's just too many factors. We need a way to sort of step out of what we're doing.
Okay, so Danielle, how are you positioning yourself to navigate this? Talk to us about your portfolio, wealth allocation. What does that look like right now?
Well, as I just said on Kitco a few minutes ago, I'm looking into farmland. Looking deeply into farmland, actually. I think a lot of municipalities are going to be good credits going forward. I think you're going to have to be with companies that have extremely strong cash flow. I think consumer discretionary in the United States continues to suffer, and your good staples that have great cash flow are going to be a good defensive place to hide. Utilities as well. We've seen utilities be a shining star in the current year. I'm not letting go of a single penny of my gold holdings, because even if the Fed does push forward, and I think that they're going to push forward more aggressively than what we think of as Powell. He's not going to be the same Powell who he was in 2018. I think we're going further this time because I think he wants to break housing's back, and I think he wants to crush housing. So, and we're seeing more supply come online. We just had fresh data out this morning. 1 million homes were built. Last month, for the last 5 months, we've had 1 million homes come online. A year from now, if we're sitting here, we're going to be talking about an oversupply issue in the housing market, which nobody can imagine right now, but it's coming. And I think that I think Powell's going to be very deliberate in attacking areas where prices can come down. So you need to have your portfolio positioned such that you're not, you want to be exposed where there's price inelasticity, and you want to shun where there's price, where there's good downside for prices, discretionary.
It sounds dramatic, but it's actually, the way I'm interpreting this is like, oh, it's a return to sanity. Like how lovely, right? Land, right? Gold, value, cash flow, right?
But not real estate.
But not sure? Okay.
I have to be really crystal clear on that. Commercial real estate is going to be in the pisser. Residential real estate is going to get hit hard. What you consider to be traditional hard assets, places to hide from inflation, that is not the case when Jay Powell's on the warpath.
Outside of gold, as you mentioned. You said you're not selling a penny of your...
Even if we continue to see the dollar appreciate, even if the Fed pushes forward with interest rate hikes, gold is a place to hide when there is severe disruption in the financial system, regardless of where interest rates and the dollar are.
And I just love that you mentioned cash flow, because I think I've been asked a dozen times, what's the most undervalued asset right now? And I just say cash flow. And look, I'm very aggressive in the commodity sector, specifically in the junior mining sector. But take care of your cash flow first. Rule number one. Nomi, anything you'd add on to that?
Well, I absolutely believe that the energy transformation that we're engaged in right now, and that everyone here is very familiar with, in particular some of the exhibitors here, from the standpoint of lithium, of nickel, of cobalt, of also copper and silver and gold, and basically that array of precious metals to green metals. Because the reality is, when you have so much uncertainty in the world, and when we have real inflation in things like food and fuel, and when that impinges on countries' ability to interact with each other and people's ability to pay their bills, whatever the Fed does, the reality is that this has shown us that we need to move forward in the green energy, in the new energy, in the more efficiently, economically stable parts of energy. And that requires investing, whatever the market's doing today. That requires investing today and for the long term in these metals, in these materials, in the junior miners that are actually good. And I've talked to a bunch of them here that actually have cash flow positive now as they're going about their exploration. There's important questions to ask, right, in terms of who's set up best, who has government funding, because it has been available in this space, who's going to keep it, who also has major money management or mineral types of manager teams behind them, and who gets private placements and private investors with capital involved, because this stuff is happening We're not going back. Even oil companies are selling their assets in order to get into the new energy, more sustainable, more renewable space. And that is the spot where no matter what is happening right now, there is opportunity and there is upside.
I love that. And Danielle, I'll give you the final word.
So I would add that about 2 weeks ago or so, Quill put out a call that said long soft, short industrial. And China's not coming to the rescue of the global economy like it did in 2016. China's not going to be loading up on aluminum, iron, or copper. It ain't happening. They don't have the money. They're in recession. So if it's soft, if it's wheat, if it's corn, there should be support for that as we find out what the ramifications for this awful, awful season are going to be in terms of global food supplies. But on the industrial metals, I'm not touching them because China's not buying, and they're the world's largest marginal consumer of all of these industrial type things, and they're not saving the world this time.
All right, I appreciate that. And thank you so much for your time. I have both of you back on stage at different times today. Danielle, we're back here. Nomi, I think it's 4:30, 5 o'clock?
Yep.
All right, 2:20 for Danielle. All right. Look, thank you so much for showing up today.
Thank you, guys.
This is Jay Martin.